Hey everybody, it's Mark Yegge. Welcome to another weekly update. So glad you're here. Listen, we got a long weekend coming up, which means it's been a short week this week. Hopefully you've closed out your positions. If you're in any options, today's the day to do that if they're expiring today. And next week is it's going to be a week after Easter, so people are going to be coming back. Don't expect a big volatile week. I don't think there's a lot of announcements or anything other than earnings are starting now. But we've had a good week. I think we're in a green market now. We went green earlier this week. And let me show you what we just got off the phone talking about in my mastermind group. Let's see if I can share this screen. Share. I think I'm getting better at this. We'll see. How about that? Okay. So there is hopefully a white screen. You can see there's 4 green lights on this. We hit green 5 days ago. So we're now, time to push the accelerator pedal because we have the probabilities in our favor for the short term, right? This is a short-term market indicator, but these tend to stay in place for maybe 20 days, 15 days, sometimes 25, and then they kind of revert to the mean, and that's the way it goes. But now when it's green is when you want to have the probabilities in your favor and a tailwind, and then you can add more to your position, things like that. So this is the time to be looking at the market to be long. I know it sometimes doesn't feel that way, but that's the way it is. All right, going through some of the indexes. This is the NASDAQ. The NASDAQ was, up this week, most of it. You can see that it's trying to stay above all of the moving average, the 200, the 50, the 10, the 21. It's above all that, so that's pretty healthy, coming off a decent golden cross a few weeks back. Pretty good stuff. S&P 500 even healthier. It's way above that, and really staying above its golden cross from maybe 6 weeks ago. Really good indicator. So we got 2 indicators kind of supporting each other. The third one, Dow Jones Industrial Average, another one. A lot of up days in a row, one down day a couple days back. And basically the markets are telling us something. I'll tell you what it is in just a second. The New York Stock Exchange is the weakest one. Why? Banking, right? It's got a lot of bank stuff in the New York Stock Exchange. The big banks are all in there weighing it down. Oil is buttressing it, holding it up. But still, it's under the 50-day moving average. It's above the 200. That's a good area. But now we want to see it break above that 50-day moving average and maybe go up to that $16,000 level and test that level. That's what we want to see. We'll see if the strength can get us there. We got a green market. The probabilities are in our side, but that doesn't mean anything on our side, I should say. All right, the CBOE Volatility Index. Look at this thing. It moves all over the place, especially kind of last couple of weeks. It spiked to 3081 about 3 weeks ago, and then it crashed. So when volatility crashes like that, it basically means there's faith in the market. And I'll tell you what I mean by that. There's people that now believe that the Fed is done raising rates. They can't raise rates anymore. They've tried to break the economy. They've done a pretty decent job. There have been some layoffs, but unemployment is still fictitiously held up. They're going to change that pretty soon. But, on one hand, they bailed out the banks with a few $100 billion. On the other hand, they're saying they're raising rates. So are they really not printing money? Is this really not QE? It's QE. They just won't come out and admit it yet, and they haven't named it. They got to come up with a little catchy name to make you think that they got a new tool. It's all the same tool. They just print money, right? And they devalue your dollar. And on top of it, one last thing on the dollar is devaluing now because over the last couple of weeks, China, Saudi Arabia, Russia, India, Brazil, they've all gotten together and said, you know what? We don't need that stupid dollar thing. Russia had some $300 billion sitting in a savings account, and the U.S. just took it when they put sanctions on Russia. And you sit there and say, well, good, it's Putin. Putin's bad. Is Putin bad? Maybe we're bad. I don't know. Maybe we're bad. Ask yourself the question. Like, we're screwing our dollar up because we're basically saying, hey, if we want to take your money, we just take your money. Whether we agree with you or not, or whether you agree with Putin or not, or whatever's going on over there, but we don't really even know. We're spending more money right now on an emergency basis in a foreign country that most people can't even pick out on a map than we do in our own country. That's a problem. So the rest of the world is looking at us. They're laughing at our administration. They're laughing at our politicians. They're laughing at our banking system. They're laughing at the Fed. And we're putting all this money into the economy for free. You can't have something for nothing. The world knows it. They're creating their own currency to compete against the petrodollar, which is what, the dollar, oil always trades in dollars. Well, they're starting to trade it in rubles now. or yuan or whatever. And so it's totally eroding the dollar. Could be the beginning of the end for the dollar. Things happen very slowly at first, and then all of a sudden. So I don't know when that sudden is going to be. Anyway, enough of a rant. But now you're seeing what the market is saying to us, that the market believes that the Fed's going to print money, and that money printing is going to take us into an inflationary environment on hard assets. We already know it's an inflationary environment on the assets we buy at the grocery store, the restaurants we go to, the airplane tickets we buy, the cars we buy. Now it's going to be an inflationary environment again on hard assets, just like it's been for the last 13 years. Okay. All right. Last thing, I'll just do two more stocks. Apple, because a lot of people ask about Apple. Apple is making a perfect ABCD pattern. If you don't know what that is, watch some of my videos. But it's basically this 124 to 157 does a Fibonacci retracement down to 144. And it's going to run that same amount all the way up to say 177. That's where I see Apple going. That's the target for me, is about 177.50. We'll see if it does that. You know, it's going to not do it in a straight line. It's going to go kind of up and down until it gets there. And then you might see some selling at that perfect ABCD extension pattern. Last one, Tesla. Tesla's had a rough week, right? We've had a bunch of days down with lower highs and lower lows, and it's now back down below the 50-day moving average. Hasn't really closed there in a couple of months. And so now it's testing the 50-day moving average. It's kind of normal. I think soon as it tests the 50-day moving average, it's going to break out and roar to the other side, because that 50-day moving average is coming up against that 200. We get a golden cross. The market makers get involved. The big money institution gets involved. This stock goes to 200, which is the breakout point, goes through 217. I think it goes to 275 before it stops. We have to wait and see. These all take time. Speaking of time, spend some time with your loved ones this weekend. We got a nice long weekend. Make it really fun. Do something fun. Have a great weekend. I'll see you next weekly update. Take care, everybody. Bye.